You're watching Bloomberg Law. I'm Lee Pacchia. Late last week, we learned of a massive trading loss of at least $2 billion at JP Chase. As a result, many are now renewing calls for stronger regulation of the financial industry. Joining me now to discuss, we have Chris Whalen, Senior Managing Director at Tangent Capital Partners in Washington, D.C., and Jeff Madrick, Senior Fellow at the Roosevelt Institute. Welcome to you both. Jeff, let's start off with you. What happened here? JP Morgan lost over $2 billion doing what exactly?
Well, they said they were hedging. Hedging means you kind of tried to neutralize the risk in part of your investment portfolio. Clearly, they either made a big mistake hedging, or they were actually trying to make a big profit by taking a position. It's often called directional positions on the market.
So we're making a distinction here between actual hedging and speculative activity, correct?
Right. So it seems on the face of it, what we know from press accounts, that they were making a speculative bet on the direction of interest rates. Now, should they be making that speculative bet, especially in a part of the company where they were only supposed to be hedging, and that will become a loophole in the new Dodd-Frank legislation? That's the question.
Do we know how big the hole is?
The loophole? Or
no,
the hole?
The hole. Are we just at the end of the day?
We don't know how much they may lose. They have to unwind a position. If the markets still keep going against them, they may lose a lot more. They could even lose a little bit less.
Chris, we're talking about a lot of money here, but JP Morgan is a very large entity. $2 billion or $3 billion is a lot of money to people like you and me, but that's not necessarily something that could be problematic for something as huge as JP Morgan. If bad risk management isn't a crime and the loss isn't something that's going to tank the firm, what's the big deal here? Is the media making too much of this?
Oh, I think they are. I'm not sure why Jamie Dimon disclosed it the way he did. Sending out a little email in the afternoon. It was kind of strange, to be honest with you. But I think you've hit the nail on the head. JP Morgan has been taking risk like this. This isn't hedging. This is speculative activity. And they've been doing this for many years. You know, I often wonder what people are talking about when they talk about hedging, because in the banking industry, if you like the credit, you don't hedge it. If you don't like the credit, then you sell the exposure. You're not going to sit there and hedge it and just keep the exposure. So, you know, the way that the media and the regulators even address this subject and the way it is actually addressed internally in large banks are two different things. I don't think the regulators understand what JP Morgan does one day to the next. So to think that they are going to somehow take the risk away from these activities is absurd. The other thing you have to understand is that half of JP Morgan's profits come from financial engineering just like this. They made an awful lot of money in this business unit, many times the $2 billion that we're all fretting about now, and yet they didn't put out a press release for that. And at the same time, you know, again, what do people think the trading treasury side of JP Morgan does? Just sits there with a long-only position? No. I think the calls for more regulation, and I think the implementation of the Volcker rule itself may have contributed to this fiasco.
How so?
You got to realize the whale is the last man standing. Most of the people who work for the chief investment officer at JP Morgan were fired back in December. The whole New York team was fired. I think that that event and all of the distraction that has gone since then, which, you know, all JP Morgan managers have been either with regulators or lawyers for the last 4 months in this area of the bank. So how could they possibly be watching Bruno and what he was doing in London if they're all spending their time with lawyers and regulators?
Oh, come on
I think we've gone way too far.
But
guys, come on. In my business...
Let me say something, Chris, because you've had the stage for quite a while. Number one, it's Jamie Dimon and his group who tells us they're hedging. We're not telling him he's hedging. He's telling us he's hedging. Number two, they fought for. Let me finish. He fought for a loophole based on the fact that he was hedging, and this would help them manage their risk, not based on the fact they were taking directional positions on these securities. Number three, the reason Lee brings up the size of their balance sheet, a big reason their balance sheet is so big is because the federal government ensures their deposits. That's number 3, with which they're playing. And he's very proud of the fact that they have this huge asset base, which he calls diversified, which allows them to take those risks. So we're underwriting the risk these guys are taking. So they can, and they're right most of the time, not because they're brilliant, but because, in my view, because they have an inside seat on what's going on. We're underwriting these profits so that these individual bankers can make a fortune. Shareholders don't know what they're doing. And indeed, for the most part, these individual bankers don't take losses.
Right.
I would be happier if they had their own money on the line and we had big capital requirements so that they can't bring everybody else down.
The regulators allowed this. The Fed, Pat Parkinson, the head of Sup and Reg at the Fed, who just retired in January, they all encouraged this. And keep in mind, the derivatives business at J.P. Morgan is not levered off the balance sheet. It's off balance sheet.
Yeah, but he
so
keeps
don't talk
talking
to me about federal deposit insurance.
He keeps talking about his He keeps talking about his huge balance sheet that can absorb this. The Fed was for it, the SEC was for it, but the CFTC and the FDIC were against it. Please don't use language like you don't understand.
No, but I'm just telling you, the media is being led down the road on this story. J.P. Morgan is telling you one thing because they don't want you to look at what they're really doing. That's
exactly. And somebody should be looking, and it should be the federal regulators in Washington. That's their job. And if they made $2 billion losses, they may. That's your favorite line. Favorite line. The regulators are doing a bad job, and then 5 seconds later you say the regulators are doing too good a job, or they should be doing this.
Oh, no. They're getting in the way. That's different from understanding.
Because people have to deal with regulations, so they don't have time to deal with huge bets that they're making on the market. That's how a good manager divides his time. Come on, Chris.
I'm getting the...
Well, if you have to regulate this activity that much, then let's go back to narrow banking and let's close down the derivative market entirely.
Now you're talking a little more seriously.
Is that what
you can't regulate this activity? That's what I'm trying to say to you. Capital doesn't matter, and regulation doesn't matter if you allow these activities.
Why can't you regulate it? Is it? I'm getting the impression from this conversation that, or is size an issue? Is it just that size matters in this equation? It's too big to manage. It's too big to regulate. Is that part of the picture here? And if it is, what does that say about too big to fail? How do we move past this where we're not worrying about a one-off trading loss from a bank and get to a system that's a little bit more sustainable in the long haul? Or is this just the way life should be? Is this a sustainable situation that we should all just learn to deal with?
Well, let me answer this, because Chris keeps telling us you don't understand. We do, frankly, understand. I just wrote a piece about how hard it is to keep these risks down. Higher capital requirements would make a difference. Separating this kind of activity from more plain vanilla banking would make a difference. Is too big to fail the big problem? I'm not so sure. I think too interconnected to allow to fail is really the issue here. But yeah, we can begin to regulate this. We can narrow it down. But the banks have fought it successfully, and even if we had a Dodd-Frank passage of the Volcker bill, it probably wouldn't have been relevant in this regard. One more thing, however, if we made these derivatives transparent, if they were on a clearinghouse and somebody knew the prices and knew what was going on, that would help enormously. And the big banks are even fighting this.
Just a small tweak like that can help.
That's not a small thing. That's a big thing.
How so, Chris?
The problem with, let's divide the products between those where there's a visible cash basis market and those where there is not. You can't really exchange trade products unless there's a visible basis. Corn, treasury bonds, gold, whatever it is. In this case, though, you have complex structured financial instruments where even the trader may not be sure what the basis of the trade is. So no surprise that the correlations in this exposure went wrong. And there is no amount of capital that you could put up against a trade like this where it's so speculative that you really don't know what the relationships are going to do. That's the real point I'm making. So you're right. If you want to make the system safe, you have to prohibit this activity entirely for banks, and they can only trade instruments that you can, in fact, trade on a public multilateral exchange. Because as long as we keep this bilateral model, I don't care if you have centralized clearing, I don't care if you have a regulator sitting on the lap of every trader in the enterprise, you can't regulate it. It's impossible.
Well, we agree on this, a bilateral system that's obscure and opaque
Yes.
is just not going to work. We need an open system.
Now,
Well, it's a ghetto. It takes us back to 1910.
So are we talking about reinstating something like Glass-Steagall? Is that the quick and dirty way to make life easier?
Well, a different kind of Glass-Steagall, where we can separate safe banking activities and where insured savings accounts do matter, and where shareholders have a say, from highly risky banking activities. We still have a problem if the highly risky banking trading activities get very big. They too can bring down the market, whether they're separated from safe, plain vanilla banking or not. So, in my view, higher capital requirements would make a difference because it would make it more costly to speculate. Would there still be speculation? Would there still be unpredictable losses? Would there still be correlations that fail? Sure. The correlation failed for long-term capital management. I'm pretty sure these guys at Citigroup, the thing that interests me most is Jamie Dimon started talking about it in early April. Did they really begin to unwind those positions, or did they, in the colloquial, double down on those positions because they thought the correlations would come back into line? That's what happened in the end to long-term capital management, which always believed if they waited long enough, the correlations would come back to line. They would revert to the mean, so to speak. Probably their traders were doubling down. I'd love to find out more about that.
Chris, bring us home here. What should regulators be doing next in light of this trading loss?
Well, they're going to run around and have an investigation. But, the thing nobody wants to talk about is that there aren't enough real economic activities for these large banks to deploy their assets in. The real bottom line here is that there's not enough business connected to the real economy of business and commerce for JP Morgan. So in order to generate the earnings per share, the revenue, and everything else that Wall Street expects to see from this bank, at least half of the enterprise is engaged in credit speculation, arbitrage, what have you. We all saw the show that Frontline ran a week or so ago. Those kids that they featured in that program are the ones who created this problem, because everybody expects JP to be able to parse credit a million different ways, oftentimes without a visible basis market for the trade. So again, I don't think you can have enough capital to prevent occasional events like this that are going to make everyone say, oh me, oh my, we need more regulation. I don't think that's going to help us. Ultimately, we need transparency, we need a lot of other things, but to me, more regulation is just going to help slow the economy down more.
All right. Gentlemen, we're going to have to leave it there for now, but I want to thank you both for your time today. This has been a spirited debate on an important issue.
Thank you, Lee.
Thank you. Jeff Madrick and Chris Whalen. If you'd like to learn more about the cases and issues we just discussed, be sure to check out our offerings on BloombergLaw.com and also on the Bloomberg Terminal. I'm Lee Pacchia. Thanks for watching.